May I?
Yeah, please start.
So, ladies and gentlemen, welcome to today's event on Credit in Motion, Understanding the Modern Credit Landscape, brought to you by Fintelligence. My name is Carolina, and I will be your moderator. In the next hour, we will look at some simple questions. How is the modern credit and financial changing? How can you avail yourself of the appropriate type of financing in this modern time? Remember, traditional bank credit is tiny, private funds are racing in, and technology is rewriting how every decision gets made. Our goal is to cut through the jargon and hand you practical insight so that you can be clear about the modern credit and financing landscape. To do that, I'm joined by some wonderful mentors and advisors of Intelligence who are expert on this topic, and let me welcome them one by one. So, Mr. Stephen, welcome. Stephen is a leader and expert in credit and microfinance. He has spent 2 decades on the front of line of risk management, chartered banker by training. He rose through wholesale credit desk in the United Kingdom and West Africa before moving into C-suite advisory roles. And today he serves as non-executive director at Sitiamo Technology, Nigeria's largest non-bank micro leader to market women. And he's also an excellent advisor. He helps clients drive strategies that align risks management with business objectives. Then we have
Thank
Mr.
you,
Sonish.
Carolina. I'm happy to be here.
Welcome. Mr. Sonish brings over 25 years experience in credit, fraud, and risk compliance across the Gulf and India. So after leading credit and underwriting and fraud prevention units at HDFC Bank, he moved into the UAE, where he now serves as a senior banking trainer with the reputed Emirates Institute of Finance and consults for Kaplan Middle East. He undertakes e-learning content development and curation and delivers training and presentations on topics related to credit and fraud, risk management, fraud prevention and detection, anti-money laundering and financial crimes and cyber crimes. So welcome, Sonish.
Thank you very much, Carolina.
Mrs. Shati, she's an investment banker and an expert mentor. She's a leader in financial risk management, compliance, conduct, control, assurance, governance, and culture, with a track record of executing regulatory remediation and strengthening risk frameworks. And she also serves on advisor boards globally and is an official UN Women UK delegate. So, Shati, welcome.
Thank you, Carolina.
And of course, Mr. Nurul. He's an international investment manager and a startup mentor. He's the vice president of CEAF, which is a renewed impact investment manager belonging in the top 50 in the world. And he serves as a board and advisory member in some of the world's renewed international organization. So welcome. He's also going to be the co-moderator today. And now I hand over the hosting to Nurul, and the panelists will answer your questions on the modern credit landscape. Over to you,
Nurul. Thank you. Thank you, Carolina. Thanks for the wonderful introductions of the panelists. And also, I can see people are joining the time. So we have received actually many questions, forms, registration forms, and I will check one by one with our respected panelists. So the first question is very interesting for the panelist. This is about the one big change that has emerged in the last decade, like in the last 10 years, for SME and corporate finance or corporate loans. So in your own opinion, experts, you can actually guide what is the biggest change that you have seen in the last decade for SME and corporate finance?
Okay.
I'm happy to go first.
Please,
Or-
yeah, you can go ahead. Yeah.
Thank you, Nurul. I think one of the biggest changes that we've seen, and no doubt everyone will agree, is the fintech platforms. They've really disrupted the traditional financial offering, faster and making it more accessible to get lending options than we've ever seen before. This emergence of the fintech market and the impact of that to the SME, that's been what we previously understand is due to before the rigid requirement of the traditional bank, that's changed. It's become more flexible, more agile, so you can get more access to lending. And that's really made a big difference in terms of the rise of the lending model that we see now. I mean, banks still are the dominant in the corporate sector, but the impact has been great. It's democratized access to capital for small businesses and startups. I think that, for me, has been the biggest change in the market, the accessibility of funding.
Yeah, great answer. Sonish, you wanted to add anything?
Yes, as what Shati rightly pointed out, I mean, just add two more things which I wanted to point out, especially in the last 10 years, I've seen, especially in the UAE, has been the digital transformation in terms of, especially on the lending criteria, as well as right from customer onboarding, digital verification, identification, and right up to the loan origination cycle. We've seen a lot of digitization happening. Automation, yes, from the manual processes, but digitization to help, for example, credit, faster credit decisioning, more of credit bureau usage, more of social media networks, transaction monitoring. So digitization is changing the way banks approach and focus credit lending to SMEs. That's part one. And secondly, of course, is a shift towards ESG, environmental, social, and governance. All our major banks, especially in the UAE and India, are being focused generally on green bonds, sustainability financing initiatives, and in fact, they are rewarding. So, digitization and automation is one major shift, and of course, is towards ESG initiatives, financing very easily available through ESG projects all over the world.
Great. So yeah, ESG, this is the evolving topic, especially in the last decade. And what Shati has pointed also is these are major points for the last decade. Yeah. Stephen, you wanted to add anything?
Yeah, I'll just add to what my other colleagues have said by saying that in addition to digitalization, automation, the fintech emergence and all of that, there's something very critical that also happened, which is the need for the market to understand that there are alternative financial options, right? Unlike prior to then, when everybody just faced the bank, the traditional bank. So now the events that happened with the banks holding back due to regulations and all of that had made small businesses, especially, right, to look elsewhere, and that the fact that other options have emerged has also made businesses to scale up, right? And also some businesses have been able to do quite a number of things so phenomenal that ordinarily, if they had been so reliant on the traditional banks, the economy wouldn't have grown and we wouldn't have had some very phenomenal transformation that's happened within the last decade.
Excellent. Yeah. The following question is even more interesting. Like it's about traditional banks' recent ways of financing, how open or closed they are in terms of lending. So, what's your view? Like traditional banks, they are becoming increasingly selective. Do you agree or disagree with this statement, mentors?
Okay,
Yeah.
let me start.
Yes.
I would agree with that because having operated in that line of business for for more than a decade, and it's nothing far-fetched. It's expected with changing regulation and the need for traditional banks to adhere to regulations. Compliance is also changing. There are a lot of things we're not how we used to be prior to the financial crisis. And that has changed even the focus, the expectations of the regulators. So in a situation where you have the banks complying with a number of financial metrics in terms of how much loans they can give relative to the deposit that they own, keeping with liquidity ratios, keeping with cash reserve ratios, and also the need to also show up their capital. As you would have noticed in some clients, even the regulators are asking banks to increase their capital, and capital has to also measure up to the level of risk that banks are taking. So that mainly has really affected the lending decisions from bank, and in order to keep to and to also keep to what level, as in what leverage they're also allowed to take. So a lot has happened due to changes in the regulations.
Yes, excellent. Anything else, Shati or Sonish?
I may add, and I think going from what Stephen has said, and especially given my regulatory background and seeing the expertise, one thing that I have seen, especially post financial crisis, is that the higher capital requirement, the capital adequacy requirement, specifically in terms of the Basel 3 and 4, that's really made organizations like the banks to ask more what sort of their quality of their capital as well is, because they have a very big credit risk concern. And then more recently, living in this uncertain environment is the economic uncertainty and the geopolitical tension that's been happening. And that's really impacted the global supply chain, and there's a big disruption. So that's really made it more challenging. Banks are looking at more risk mitigation and focusing on clients with a stronger financial background. So sometimes it makes it harder for smaller and startup firms because they want to look at people with track record and stronger. And then from a UAE experience, and maybe Sonish would can add to it, is that I've seen that in the UAE they are even more conservative, especially when it's expats and small SMEs. Unless you're backed by a big family office or a big name, there is that extra scrutiny for increasing capital and the quality of capital. So that's my take on it.
Yeah, thanks, Shati. And I want to remind the audience, you can ask any of your questions in the chat box. So if you go to Zoom chat box, you can ask your questions. And if you want to ask directly, you can raise your hand. So we'll give the floor. Sonish, you wanted to add something?
I think very correctly put by Stephen and Shati. Shati, just to add for the UAE perspective, two things which have come out very clearly is the banks are increasingly looking at good corporate governance. Companies, business houses, as rightly pointed out, which are family driven in the UAE or erstwhile, if they're driven more in terms professionally, in terms of more corporate governance and clarity, strong internal controls, those are being rewarded. That's part one. And part two, modern banks are now looking at real-time monitoring of credit. For example, in terms of credit dispersals, loan governance, repayment. So banks are not taking one solution for all. They are constantly monitoring, reviewing collaterals, governance, more proactive. Of course, digital tools have really helped, but good corporate governance and a strong automation really helps bank to decide a client much faster, maybe at a much better rate.
Yeah, so we also hear some pain points from the applicants in different banks or financial organizations. They cannot take the financing as they want. On the other hand, banks are they are saying that the non-performing loans or default rates are increasing over the years, especially in the emerging markets. So, in your opinion, what should be done to improve the credit evaluation so that on one hand, the entrepreneurs or the founders can access the credit, and on other hand, banks can minimize the default rates or non-performing loan? So that question came up. If you can, anyone to answer it.
Okay, Nurul, let me start. In terms of not only speaking about UAE, but back home in India also, there's been increasing focus from banks and, of course, pressure from regulators, especially the central bank, in setting up, of course, as you rightly pointed out, non-performing assets, ratios, and provisions for that. But banks are increasingly being asked to being very selective. That's one. As I told you, ESG, corporate governance, and digital onboarding are tools. Secondly, in terms of ensuring a proper collection setting up mechanism, in terms of asset reconstruction, collection, debt consolidation, there are a lot of tools which banks are now using to ensure that they don't reach a stage where it's 100% provision and write-off, especially on assets. So right from the step of understanding the business, coupled with the fact they've been held by credit bureaus and a regulatory authority. In real estate, you have the RERA. In credit, you have the credit bureau, which are being developed. So strong credit decisioning, not only once at the time of loan approval, but during the whole loan life cycle or lending life cycle, banks are constantly monitoring credit with covenants and collaterals. At any stage, as an early warning or a red flag, banks are being putting a break to it, not only in terms of stopping or writing up that loan or making a provision, but actually going and talking to the SME, understanding the market, understanding the business, whether it's an MSME or a SME or a local or small corporate. So given the fact you have a regulatory framework which gives you an asset reconstruction company or debt consolidation, from a bank's perspective internally, from the credit and the collection side, they are being more proactive, especially the time of credit decisioning and monitoring. And at the time of collections, rather than go and put it as a bad asset and put a pressure on your balance sheet, they are now talking to defaulters or debtors to get into reconstruction, reconstitute their business, in fact, a lot of telecom companies where they've been asked to convert debt into equity. So you'll have banks who've now taken up ownership in these companies, not with the fact of running the management, but keeping an watchful eye on the management. So again, a good corporate governance in place. That is what maybe the latest trend I could say the banks are doing so.
Yeah, Shati or Stephen, any thought regarding
Yeah,
this?
and I was thinking also in this AI environment and where the future is going, and I've seen quite a lot of it where a dynamic bank or where they want to be the use of behavioral data and where they can proactively look at any flags or risk indicators ahead of the time. And I think banks are really, or corporates are using that, which will help them in the future. So if they have a non-performing loan at one stage, it could just be a stage as opposed to an indicator of what it's like long term. So where they're using alternative models, more dynamic tools and stuff, that really helps going forward, and they're not relying on that old-fashioned, that pressure of keeping that balance sheet on that. So I think that's a tool that is beneficial going forward.
Great. All right.
Okay, I'll just want to add that in addition to what Shati and Sonish had said, I think it's also important that we cannot overemphasize the importance of KYC, knowing your customer. Because most times you find out that most credit that goes bust or bad or default credits are usually stemming from the origination of the credit. And as you move on, there's hardly, less than nothing that you could do to correct some things when they're wrong from the start. Yeah, you can do all to salvage it, but when the right customers borrowing customers are not identified, it becomes a challenge. That's one. Again, I think it was Shati that said that with regards to the models, the old-fashioned model, and the need for some of this model to be upgraded, banks also need to be a bit flexible, right? Enabled to accommodate like the small businesses, the entrepreneurs, and some complex transactions that may not really fit into this. Is not like a one size fit all kind of thing. So that is also important. And I would also round up by saying that there's need for banks to also be more proactive, right, in taking some steps in addressing delinquencies or when there are red flags. Sometimes their actions are taken when it's almost too late, all right? And that also informs why some very drastic decisions are taken.
Great answer, Stephen. So the next there is about alternative financing options. So people are saying like banks financing are becoming more challenging, especially in the post-COVID regime. They are facing difficulties to access the credit, and people are looking for alternative options like private credit or private equity or any other alternative channels or options for them. So what's your opinion? Like, do you see any emergence or any growth in the alternative financing over the last 5 or 6 years, especially after the post-COVID regime?
All right, Nurul, I would like to point out the three acts. In fact, I would break up into three industries. One is trade finance. Now, trade finance, especially in the UAE is a big trading hub. Trade finance is a big option, a big use or a big requirement there. That's part one. Now, given the fact that traditionally banks and financial institutions have basically ruled trade finance, a lot of trade finance options, alternative options of bank credit are available. For example, right from forfeiting and factoring, which are traditional, you have invoice discounting, bill discounting, suppliers credit, which are very short term in nature. So those are available in terms to both importers and exporters party, not only from banks, but by local fintech players. Why? Because the local fintech players know the market, know the industry, know the business. And more importantly, as Shati had also pointed out, family-run businesses, which are very prominent in UAE. A very specific trade and in a country example, that is helping a lot. That's part one. From an agriculture point of view, I've seen a lot of green bonds, green initiatives, especially one of the largest banks, Emirates National Bank of Dubai in UAE, has been very forward-footing in coming out in awarding or rewarding customers with carbon credits, zero carbon net emissions, green bonds at a much lower rate. That's one much more better financing facilities is coming out. And third, of course, as you rightly pointed out, Nurul, private equity, private debt, private placements, and of course, very similar to startups where banks or institutions are investing money, not only debt, but participation in terms of equity, which is happening, or private placement of debt. That's also shaping the way small SMEs, medium SMEs are getting alternative funds or financing methods.
Yeah, absolutely, absolutely, Sonish. And I personally agree with you because I'm also working in the private equity and private credit space for the last, I think, 15 years.
Wow.
So, yeah, particularly we have seen the rise in the post-COVID regime
Exactly.
and growth. I think in the last 10 years, it was tenfold.
Mhm.
So this sort of growth was like amazing, even out of our prediction when we started business in different markets. Yes, Shati or Stephen, you wanted to add anything?
And I was going to say, as you said, there is definitely a rise in the private equity and the venture capital, exactly where you specialize in, Nurul. There's, dedicated, there's created, the banks are creating dedicated debt arms, especially specific for private equity and VC firms. But another thing, and I think adding to Sonish, is if I look at it from a very risk part and a very safe part, is the sovereign wealth arm. So that would be from the very safe part. And then the risky part, the alternative part, is there's a significant activity in the restructuring of distress lending and growth debt. I think the alternative ways of thinking and raising private credit, or people are being a bit more imaginative. And the ecosystem is changing. There is an appetite for it. And there's something called mezzanine debt, which is a hybrid approach with the lending. So,
Yeah, great.
So I'll just want to add that looking at the supply chain space, there've also been increase in attention to receivables financing,
Yeah,
right? Creating options in that space. So and that you could do with a lot of investors coming in to fund invoices and transactions in that space. And also within the last within this last decade, there's also been increase in credit guarantees, right? And that also has given opportunities for um, um, businesses that are not able to meet the very stringent requirements of the traditional banks to be able to also access credit. So we've seen a lot of credit guarantees schemes, coming up, and especially from development finance institutions, right, trying to encourage lending to the small and medium scale businesses.
So I was muted.
Yeah.
So great answer, everyone. So we have already discussed some types of financing. So we got some questions like what are the different types of financing, alternative financing that actually people can avail from different institutions. So we have already discussed it. But could you please highlight the best possible way for entrepreneurs, especially for the startups, to get most appropriate type of financing or alternative financing? Like, for example, if a startup is starting a business 1 or 2 year, so what sort of financing in terms of alternative finance would be most appropriate for them? So they are asking like, should they go for equity or should they go for debt? This is a common type of question. So what is your answer?
Oh, okay. Nurul, if I may take the lead on this, startups we've seen, especially evolving in India and UAE. The very fact, as you rightly pointed out, there's always a devil's advocate. You take more equity, or you dilute equity holdings, or you take on more debt. Especially the risk is, of course, you just started up. Given the fact whether it's a matured industry or it's in sunrise industry, the very fact is that, especially for matured industries, established industries, apart from the threat of competition, an existing product you have, there more startups could look for a little more debt as compared to equity in their portfolio. But sunrise growth industries, IT, IoT, artificial intelligence, of course, these are of course full of risk reward patterns. They would more look at equity participation. And once you build your brand name and brand equity, apart from the fancy valuations,
Yeah.
banks and venture capitalists are definitely looking for some meat out of it, strength and core of the business. If it's a matured industry, sunset industry, that's no problem because you already have players in that. But especially for the sunrise industries, the IT, the venture capital, the startups, and especially in the artificial intelligence, machine learning space, they all startups are advised to practically basically start with a low component of debt, build as and when revenues justify that, link your debt acquisition to more onto revenue and cash flows. That is part two. And look for alternative mechanisms. Don't traditionally go to banks, go to fintech players who, on basis of their automation models, more into on fintech or more into AI, would be able to gauge much more concurrently, much more frequently, the requirement of credit. That is part one. How credit is utilized. Is it mapping with revenue and cash flows? So for startups in the sunrise industry, Nurul, I would strongly recommend low debt, very low debt, build up debt, get more equity. Once either you reach that sunset stage or to the matured market, then of course you can get more debt. That's my view.
Thanks, Sonish. Perhaps you have shared the golden formula to them. Many of them know about it. So yes, I believe the audience are taking notes because this is important. And what you have said, I 100% agree with you, Sonish. Stephen, Shati, any comment about different?
I am 100% in alignment with Sonish. And as I always advise, even the startup that I've worked with, I'll say exhaust your equity options before you approach debt. And that also that doesn't keep you under pressure, right, from debt. So it allows you to plan and it allows you to grow. And when you've grown and you're now, understanding what the terrain is, then you can just gradually get into the debt space. But in 100% alignment with what Sonish said, with regards equity first.
Yeah.
It's just that's window first.
Right. All right.
I also think alternatively, and I completely agree, I think both Stephen and Sonish has had more experience and they're more wiser on that, is I also think look around your network as well initially, those people who have bought into your dreams, seeking to the people who believe in you or are going to support you at the beginning. I think it's always don't look far afield, look people who would support you first, because that's always a good starting point in terms of getting people on that journey with you who are prepared to go on that journey or take a risk. I don't want to use the word risk, but don't be shy to ask people close to you.
In fact, Shadi, you could put it as leap of faith. Take the first leap of faith.
Absolutely, yes. All right. So I'm moving to the next question. So some of the questions actually we have answered in pattern, like for different types of financing options and most suitable for which one is most suitable for the entrepreneurs. We have answered many of the questions. Now, we will talk about credit evaluation and assessment. Like credit evaluation, it is changing, especially in the past decade, and we believe it will also change in the future. Like what we have seen in the past, this sort of change and development will continue, particularly what Sonish, Shati, and Stephen highlighted, like about automation, digitization, and use of advanced technology. So there is an interesting question about how do we see credit evaluation assessment evolving in the next 5 to 10 years? So how do you see the overall credit evaluation and assessment? What's your view?
All right, Nurul, so from a credit point of view, since I've managed underwriting for a lot of banks and a lot of portfolios, what I've seen traditionally from a manual process some 20 years ago, where we were more relying on pieces of information and data given by the borrower himself or herself, or the business himself or herself. And it was more of a proactive, reactive approach rather than proactive, where we were looking at documentation, we were looking at business trends, market trends, industry, more from a reactive point of view. Our sources of data were limited. We didn't have automation, we didn't have credit bureaus, we didn't have a regulatory authority. That was part one. We didn't have real-time monitoring systems to track transactions, take out red flags for money laundering, because money laundering is, of course, now the major problem statement across. So credit, of course, has moved across right from evaluation from the 5 C's of credit, traditional 5 C's of credit. We moved on, given the fact that 5 C's of credit still remain the bedrock. Tools like digitization, automation, API softwares, automated programming interfaces with the regulatory authorities to rule out impersonation thefts, because now credit is merged with fraud. When I'm underwriting, I'm more looking at underwriting, let's say, a loan or a project proposal for an SME, rather than do evaluation of his business strengths and pros and cons, which I will. But I'm looking at a fraud angle much more. Two things which have come up from a credit, one is anti-fraud, the other is anti-money laundering. So systems, businesses, programming softwares, automation will be driven by credit by these two factors in mind, to rule out the fraudulent element and, of course, rule out the money laundering element. These two elements are very, very important. And of course, with KYC and CDD, the thrust focus on credit is constant review. The only thing which is constant is change. So review, come back to the writing board or the whiteboard, restructure, and hold the hand of the businesses right from loan origination to collections management. That's what, in brief, I would like to say.
Right. Great answer. So the mic is also open. Someone requested if anybody wants to ask any questions apart from the form questions, you can ask or raise hand, or even flag in the chat box. So Carolina, if there is anything, just let us know. Okay. So yes, I was asking like what will happen in the next 5 to 10 years, and Sonish pointed some important issues. Shati or Stephen, do you have any comments regarding credit?
Okay, let me add that yes, in addition to what Sonish said, a lot is changing, and I think it's also time that those in the credit space start looking at credit in isolation. And in evaluation, there will be a lot of, as we've seen with the changing regulation in terms of compliance issues and the need for compliance in anti-money laundering and all those other areas of operational risk, which needs to be focused on. right now, because there are a lot of things that prior to now it's always relegated to the background. But now, in evaluating the credit, one has to look at things holistically, right? Covering all the key areas of credit. So things that were not really things that you look at as doesn't matter in the past now are receiving a lot of attention. And with regards information also readily available, I think there's something interesting happening in the open banking space, right? Which also allows the free flow of access to data and all of that. So a lot is happening, and that will impact on how credit is being evaluated, how a different look, right, to taking decisions on credit request.
I think, Stephen,
Yeah.
the key thing that after Sonish and what you've agreed is that regulation of the open banking and the usage of data. I mean, data is the thing that drives everything, given that the AI-based lending decision, I mean, that's always going to drive things. And as we more base it on AI and predictive real-time underwriting, the risks are greater as well. The op risk element is going to go higher in terms of the evolution of credit. And in terms overall, my summary would be that the risk adjustment will be more personalized. The lending will focus that way, because as we have more access to data, it could be more personalized. We can look at early warning indicators. So that's what makes it better in the future than it was historically.
Yeah, great answer. So now moving on to the next. People are raising funds, especially looking ahead 2026 and the later quarters of 2025. And they're asking for the best advice. What sort of advice that you expert can give them to raise funds, particularly business expansion or for working capital, anything. So what's your biggest advice, one piece of advice for the entrepreneurs that are listening for raising funds in 2025 or 2026? Experts.
Yeah, okay. So in terms of forms of funding available, we've in the last couple of years, we've seen a lot of foreign debt coming in, external commercial borrowings from a country's point of view. Companies, startups, new ventures are not only looking at local market credit, that's part one, but they're also trying to venture out in terms of whether it's private debt or equity participation to foreign markets. A, in terms of cheaper access, cheaper credit. B, with the fuel and rise of correspondent banking, that's also driving. So if your bank has a correspondent banking relationship, especially in trade finance or other areas, there is a possibility of getting access to cheap credit. That's part two. And part three, of course, are different hedging strategies and options which are available in the international market. So be local, go global. I think that's the new buzzword. Be local, go global. Grow global in terms of both in market expansion and most importantly from a credit point of view, or from a lending point of view, or securing strong sources of credit, continuous sources of credit. Of course, is getting an external commercial borrowing or a foreign participation, both in terms of, as I pointed out some time ago, we were looking at equity focus rather than debt, especially for startups and entrepreneurs in any part of the world, and that's part two. And most importantly, get your house in order. Good corporate governance, strong internal controls, fraud awareness training, anti-money laundering training. We're not saying stay shy from regulators, because regulators are there to lend. And especially the online payment systems. There's a full ecosystem for online payment systems. Today, we order, we buy, we sell on online payment systems. Three areas of focus: online payment systems are the much more in demand, or online delivery services, I would say. That's part one. B, they are generally backed with venture capitals and startup funds. Two. And three, rather than look at valuation of 20 billion or 30 billion, which has become don't look at valuation numbers. Look at your market, look at your core strengths, look at your corporate governance, look at your leadership, tone at the top. That will drive. So whether you are in sunrise or sunset industry, irrespective, what will drive alternative source funds are access to external credit, good corporate governance, with strong governance, internal controls framework. And third, most importantly, solid markets. Establish yourself. I'm not saying undercut pricing and all, but get your brand equity, brand name much better than valuation. So your brand equity and brand name sells much, much, much better than a 20 billion or 30 billion valuation. That's what gets rewarded.
Right. Anything else? Shati, Stephen?
And I think what Sunesh said, and definitely the final one, get everything in order, is it nicely goes is be fundable before you seek funding. Don't wait till you need money. Start preparing, build that relationship early, build your brand. It's not just a glossy pitch deck, but be transparent with your data, frequently share them, build that confidence in trust, because it's all based on trust. I think we should never underestimate that relationship building and trust.
Yeah, absolutely.
Okay, I'll just like to add that yes, put your house in order and get things right. By so doing, you be a good bride to whichever lender is the seller, right? In this I mean, if I'm allowed to use that illustration, and at the same time, I would also say that when seeking for fund, I always advise that you explore local funding first. And the reason is because of the market is going through a lot of volatility right now. And when you understand your business model, you'll be able to match the funds accordingly with the cash flow that you generate. So there's no, if a business, for instance, is not generating foreign currencies, I really don't advise that you go for foreign loans. I mean, yeah, they are cheap, they could be cheaper, but the risk that is also involved, especially with what the shakeups that we experience or that we're experiencing right now. So I would always, advise that caution that starts first with what you have available locally, and then when that is exhausted, you can then look out for the foreign fund. But you do that also cautiously because you must be able to match the risk.
Right. And one related question, like what Sonish said earlier, like how entrepreneurs or founders, they will find the global investors. So one piece of advice from myself is don't be shy. At least send your pitch deck or whatever you have to international investors. There is no good or bad time. You never know when we'll pick you at what time. So we have dry powders, we have cash now, and we are looking, even investors are looking for businesses globally. So as Sonish and Stephen and Shati said, when is the right time? Definitely you should focus on raising funds. That's it. I think there are no more questions left. So we are perhaps at the end of the discussion. And mentors and advisors, if you just say a closing thought for the entrepreneurs, like what they should do for raising funds and as a whole overall for this year and next year, for overall your guidance for the entrepreneurs as a closing thought.
Nurul, I would say, given the volatility which Stephen correctly pointed out, what world markets are going through, whether what US president is doing, irrespective, the world over, the mood is caution. Whether it's local markets, international markets, wait and watch. That's one. It gives good time for entrepreneurs to set up their house, as we repeatedly pointed out. Get core business, good pitch decks, solid business model up and running locally. That's part two. Maybe not a big thing. And as Stephen correctly pointed out, get access to local credit because local banks do understand local business and local market. That's two. And let the volatility pass. I know it's a question of market. Markets will bounce back. That is, well, let some tariff regime and sense prevail in the market. That's part two. Given the fact that, even companies like Apple and Meta are in a political fallout with the president of the US. So irrespective of that, that's two. And third, most importantly, as I repeatedly pointed out, corporate governance, strong ownership, very good management will always be much, much better than numbers. It may not come out in numbers, may not be visible, but inherently, investors are all, venture capitalists are all looking at strong management culture. Well-driven companies, professionally managed. That's part two. And finally, third, Nobody can live without digitization and automation. I'm not saying all your businesses should be digital or on the online payment system, but access to your product and services. Your business should be driven by a model which is digitized, automated, so that you're not left out in the competitive market. No, not everybody is a bank or a financial institution or an AI startup. But for example, AI, AI is everywhere. Whether it's workplace, it's electronic showroom, or a laundry, or a digital software company. Automation and digitization at this point of time, when the markets are struggling to get a balance, is the key word and mantra.
Thanks, Sonish. Shati, Stephen?
I would say what Sonish has agreed is the main thing is, navigate the fintech landscape and make as much use of as you can of the AI that's available and use different tools, because that is the future. And the more we understand it and the more you educate yourself about it, it's a tool there to help you, not to replace you. And I think that would be my key advice, is use as many things that will automate things, make it more efficient and give you that competitive advantage. So that's my key thought.
Thank you.
Okay, I would advise that entrepreneurs should put their house in order. And when I say put their house in order, is by ensuring that you embrace corporate governance. And because in presenting your case to a financier or a funder, they want to see how well you have also put your house in order, how well you have, you understand your business. And they also want to see that you have some skin in the game, as we're saying in credit. And with that, what is also most important is also building on track record. Character is very important, and that's where trust come in. The central focus, right, of finance, as it's where, is still aimed on trust, right? If I'm not able to trust you, then I cannot part with my funds. So be it equity, be it debt, be it a grant or what have you, I must be able to trust you, right? So that is very important, that people also do business with a lot of integrity, and they're able to, to showcase whatever they have proudly. So when you believe in yourself, when you believe in your product, it's easier, right, to convince a third party about how to support you thereafter. But when you yourself do not have that confidence, it becomes challenging. So those are the areas I would advise that they look into.
Thanks, Stephen. So finally, I am just summarizing what we have discussed today. Many of the entrepreneurs, they couldn't join. Perhaps we will send them the recording. So we have discussed about different credit types and what sort of financing is more convenient to different sort of entrepreneurs and founders. And we also discussed about different challenges and also looking ahead how we can avail financing like in the next 5 or 10 years. We discussed about technology, we discussed about automation, we discussed about regulation and compliance, many things. So I believe it will help everyone who are looking for fundraising. And thanks for the entrepreneurs. Thanks for all the amazing questions that we got through forums. And if you have even any further questions, please feel free to reach out to us through email or through our LinkedIn page. So thanks, everyone. Have a very great day, and we look forward to see you in the next event. Thank you.
Thank you, Nurul.
Thank you.
Thank you, guys.
Stephen. Thanks, Sonish. Thanks, Shati.
Thank you very much. Thanks,
you, Lina. Bye.
Thank you.
Bye, Shadi.
Bye-bye.
Bye, Sonny. Bye.
Bye, Stephen.
Bye, Caroline.
Bye.
Thank you.